Hello traders, Igor here, MrTopTick.com. Welcome back to the channel. If this is your first time tuning in, please consider subscribing to the channel. Leave a like if you enjoy this content, and feel free to share this video with someone you think could find this information useful. Today I want to talk about one of our trades. This is a 112 Bear Trap. This trade is a part of an ongoing campaign. We put these trades on every single week, and we have one of these trades expire every single week as well. Today is February 3rd. It's a Friday. We have one of our positions that's going to roll off. I wanted to go over steps that I took in order to navigate and manage this position. I want to point one thing out is that this trade is made up of one put debit spread financed by a sale of two farther out of the money puts. Naked options they carry a lot of risk, very risky business. If you don't know what you're doing, make sure you get educated, make sure you understand exactly the risks that are involved before doing such trades. One other thing I wanted to point out is that this trade is a very easy trade to navigate in a steady up rising market. However, this is not a set and forget type of trade, because if the market moves against you, holding naked options to the downside, which carry unlimited downside risk, it could spin out of control pretty fast, and you can potentially end up losing a lot more money than what you thought you had at risk. So do be aware of that. This trade started off on December 13th. S&P was at 40.78. What I did was I picked up a 39.80, 39.50 put debit spread, and I sold two of the 3,400 puts naked for every one put debit spread. I collected $9.50 for every one of these bear traps. This is a 5 lot, and my goal was to hold on to this trade with several potential outcomes. If S&P expires above the long put debit spread, I get to keep $9.50 that I collect upon entry. If we are somewhere inside 3,400 and 39.50, I will make 30 points or $3,000 for every one of these bear traps, plus $9.50 that I collect upon entry. So this trade has a potential of making close to $4,000 for every one contract. And the potential outcome number 3, if the market moves aggressively against me, I will need to figure out a way to balance my net directional exposure, and if my losses on the way down exceed what my max potential reward inside the bear trap is, I will need to consider stopping myself out to preserve financial as well as mental capital, and look for another trade setup. So this trade was put on the 13th of December with S&P trading at 40.78. We're going to take a step to the next adjustment, which was just 3 days away. And here's where we are. This is 3 days in the trade. S&P moved almost 3 standard deviations against this position in 3 days, which is a lot of speed. And now we are almost 300 points lower than where we were just 3 days ago. We are now inside the trap, which is really not a problem. However, we got there really fast, and we still have 49 days until expiration. As you can see on the way down, my T+0 line is really starting to get steep, and if I leave this trade unattended and the market continues to move against me, things could spin out of control pretty fast. What I decided to do here is I went ahead and I picked up a 3,800 strike put in order to cut my delta, and this is what my trade looked like after I made this adjustment. I spent $98.40. I picked up one put, so I spent $9,840 on this hedge. This took my, if you look at delta here, before making this adjustment, my delta of this trade was plus 76. After I made this adjustment, this took my delta down to plus 33. So I got rid of about half of my directional exposure. That was my goal. Now we go to the next adjustment, and here we are. This is 8 days since we took this trade. S&P is now trading at 3877, where could look at a chart here. And so this is where I took the trade, initiated this trade. Down here is where I first made an adjustment. Now we're coming back up on the 50 SMA. We still have 8 and 21 EMAs in a bearish formation, but I'm starting to think that, the market is probably going to trade slightly higher. This is December 21st. Maybe there's Santa rally coming. I don't know. You don't know. No one does. But just in case it does happen and the market starts to run away, making the last adjustment, which is buying the 3,800 put, this did introduce upside risk. So I do need to be aware that if the market continues to run higher, I'm going to have to figure out how to remove risk on the upside. So what I ended up doing, instead of dumping the hedge that I bought, I decided to sell a put that's going to recover half of what I paid for the $3,800 put. What I ended up doing, I ended up selling a 3720 put, and I collected $49.50. So I collected $4,950 for it, and this is what my risk profile looked like after I made this adjustment. So now in this position, I have 30-point wide put debit spreads. There are 5 of these. I had just created one 80-point wide put debit spread, and I still have 10 short out of the money naked puts. My delta here is plus 24, which is totally fine. I have very slight to no risk to the upside. And now my goal is, again, to see if I can balance this trade, to see if I can capture price somewhere inside of my long put spreads and my short out of the money naked options. We go to the next adjustment. So here we are. This is 27 days since I put this trade on. S&P is down about 0.7 standard deviation, so we didn't really move too much. We are down from where we started. We can see that. So this is where I started this trade. This is where I hedged. This is where I removed half of my hedge. And now we are somewhere around 3,900. We're just kind of chopping around here, and not much is going on, which is positive for this trade. As you can see, this trade is showing a pretty decent profit so far. So what I decided to do here is I decided to close 3 of the 5 put debit spreads. I collected $15.75 for each, and this is what my risk profile looks like after I removed 3 of the 5 put debit spreads. My delta is only plus 5, which is great, really, for a trade of this magnitude, regardless of whether the market moves up or down. Or currently, I don't have much directional exposure, and that is what I want. We go to the next adjustment, and here we are. This is 38 days since we initiated this trade. Now we have the price is moving outside of my long put debit spreads. Remember, I just closed 3 of 5. I still have 2 put debit spreads here, and now the price is running outside of this bear trap to the upside. What I ended up doing, I decided to close the remaining 2 of the 5 put debit spreads. I collected $12.70 for those, and this is what my trade looks like after I made this adjustment. So now I am left with the long 3,800, short 3,720. So that's an 80-point wide put debit spread. I only have 1 of those, and I have short 10 of the 3,400 puts naked. We're fairly far away from where trouble is. And by trouble, I mean this trade doesn't really run into trouble, in my opinion, down to about 36.50 with S&P trading at 39.72. I think that I have almost 10% or so to the downside before I need to do something about this. We have 14 days left, which is a very high probability outcome that I will end up somewhere above my break even. And as you can see, this pricing model is assuming that there's close to or about 100% probability that price is going to expire somewhere above the downside break even. So that was on January 20th. We go forward 5 more days. Here we are. This is 43 days in the trade. S&P is trading at 39.63. I have 9 days to go. I'm holding a 80-point wide put debit spread and short 10 out of the money puts naked. Now we can go back and see what these puts are worth. They're currently trading for about 65 cents. Look at what I originally sold these for, $9.13. So it's safe to say that over 90% of the credit that I collected for these puts has already decayed. I decided to go ahead and buy to close these puts for 65 cents is what I paid for these, and this is going to leave me with just one 80-point wide put debit spread in case that the market does pull back aggressively. I stand to make an additional $8,000. However, if the market expires, or if S&P expires above 3,800, this 80-point wide put debit spread is going to expire worthless, and I will get to keep all of the credits that I have collected throughout this trade. And I will go over these numbers in just a little bit. So this was my adjustment. I bought to close 10 of those $3,400 puts. I'm left with just one 80-point wide put debit spread with 9 days to go. And now we go to where we are today. And today we are at 41.67 on the S&P. The remaining 80-point wide put debit spread is going to expire worthless. I get to keep the original $4,750 plus I have sold some of those put debit spreads that I originally bought, and I had collected additional credit. I spent a little bit of money on putting a hedge in place, and then I spent a little bit of money on closing out the 10 puts that were naked. So all in all, this trade is showing a profit of $6,456 in 52 days. This is including commissions and not including any exchange fees. Commissions for this trade was about $18.90. So all in all, we can look back to what happened to this trade. We initiated this trade with S&P trading close to 4,100. We took a sharp downturn. We put a hedge in place. As the market started to kind of turn back around, we got rid of half of that hedge. I started to unload my long put debit spreads into this move up, and then I got rid of the out of the money naked puts that were short when they lost over 90% of its value, and I was just left with essentially this 80-point wide put debit spread is the hedge that I had in place. Didn't pay off. The market didn't go down the way I thought it could, which is totally fine. This trade was profitable, fairly easy to manage. We never got over the max allowable loss parameter for this trade. So I hope you learned something new. I hope this is something that's going to get you to think about ways to protect your positions, how to hedge. how to manage positions similar to this if you do follow a 1-1-2 bear trap methodology. As always, take care of the risk. Profits will take care of themselves, and we'll see you in the next one.